Okay, so good morning and welcome to our new topic, which talks about tax planning. Okay, so the main aim is, of course, to determine how or what are the steps or legal steps on minimizing your tax, while, of course, following IRC's rule. And of course, we will also talk about something on transfer pricing, which will be connected on international taxation on topic 6. So these two topics will be related, tax planning and then international tax. Okay, so it's important for us to emphasize that when you talk about tax planning, it's a systematic or well planned approach in minimizing your tax, and it also emphasizes on compliance. Okay, not breaking the rules for the tax legislation. So when you compare tax planning, tax avoidance, and tax evasion, tax planning you can see here. Sorry, in the projector is really not clear. Okay. Says a process or the process of analyzing one's financial situation most efficiently. Through tax planning, one can reduce one's tax liability. It involves planning on one's income in a legal manner to avail various exemptions and deductions. So, like for example, claiming the maximum dependence because you are qualified to claim. That's also part of the tax planning. Okay, uh, creation of trust to minimize your tax liability is also a tax planning approach. So, which means you're following the rules of IRC, complying with the requirements, but still you are able to minimize your tax. Before I discuss tax avoidance, I'll jump to tax evasion. Of course, tax evasion is a legal or illegal ways of minimizing tax, and either the individual reduce the tax liability deliberately without following tax rule, or delay the payment of tax. Remember, I told you about that. They just lodge an objection so that they can delay the payment. Okay, so those are tax evasion moves or steps. Now, tax avoidance is sitting between these two. Because tax avoidance, we normally call it like a gray area. Because in tax avoidance, you're still using the same rules, but you're trying to find loopholes, on tax legislation. So, which means maybe the tax legislation is not clear enough, and then the individual had tried to maximize that. Okay, but remember, like the tax law will have same set of principles. Okay, so which means what the lawyer or the tax experts will do, or IRC, is only not looking into the specific regulations, but they will use the principles behind taxation. Okay, for example, if the tax legislation is not clear on when you're receiving money from certain individual, okay, you're receiving it not regularly, but still you're receiving maybe 10 times a year. Let's say 10 times a year. So it's not monthly, it's not fortnightly, it's 10 times. Now you say it's not falling between or within the case law. Remember the case law? Recurring, perpetual, receiving of money, sorry, not perpetual. Recurring and in series, okay, you're receiving money or regular because it's 10 times only. But they will try to find out, okay, yes, it will not fall on that regular recurring point of view, but you're still receiving the money. Okay? So looking into the principles, if anything that you receive out of something that you perform, that will be treated as income. Clear? So that is tax avoidance. It's a gray area on tax, and this most likely still not allowed under tax law. Okay? Clear? Am I clear on this? So tax planning, of course, legal way of minimizing tax. Tax avoidance, of course, those are really intentional deception on paying or the deceiving of IRC for IRC. And then tax avoidance will be a gray area wherein the clarity of the rules is not specifically stated, where some tax experts or people or individual use that loophole in minimizing tax. So these are certain way to do tax planning. So when looking at the structure of the business or group at commencement of the business. So if you want to reduce your tax, only focusing on tax, so most likely it's better for you to set up the company. Why? Because it's giving you 30% fixed tax, and also you can claim certain expenses. If you run it as a sole trader business, you cannot claim some of the expenses. Remember that? So that's first. Second, where there is consideration of overall structure of the business or group due to change in circumstances. When considering the structure of a proposed transaction, project, or asset acquisition. Remember, there are some exemption on asset acquisition and even the way you spend money. Donations to non-profit organizations are exempt. Hey, you got it. So those are like sorry, not claim, but those are allowable deductions. Okay, so you need to pay. Also, you have to look into when there is a need to reduce taxable income. So how to reduce taxable income? Of course, try your best to minimize the assessable income and claim as much as possible the allowable deduction. Okay? So these are the ways to reduce tax liability: diverting or channeling income to a taxpayer with a lower marginal rate. As I mentioned a while ago, if you're earning more than 250, okay, in a year, you'll tax around 42%, right? So instead of you being taxed 42% rate of trust, wherein you will be taxed around 28%. But if you created the company, 30%. Okay, clear? Next. Eliminating or deferring assessable income. If you're allowed, take note, if you're allowed by tax legislation to defer or eliminate certain income, then okay. Right? Accelerating or increasing allowable deduction, there are sometimes you're allowed to have accelerated depreciation, so you can claim that. Okay. Altering the period in which income is derived, but take note, not not breaking the tax law. Okay. Like for example, if you receive the income now, okay, or the money now, and then you're using accrual method. Remember accrual method, how does it work? If you only when you provide services, you will need to recognize revenue. Clear? So if you receive the money now, but you haven't performed the services, so you are not allowed to declare assessable income because you're using accrual method. Clear? But maybe you're honest, okay? So you say, we received the money, so anyway, pay tax. Clear? So trying to take advantage of the accounting method also is important. Another one, taking full advantage of all incentives and concession available. So let's talk about some specific ways. Okay, let's talk about reduce assessable income. As you can see, there are a number of items here. Okay, I'll select few and then I'll discuss. Okay. All right. Use income producing investment for negative gearing. Okay, so what does it mean? You if you are trying to minimize your income, accessible income in this case, you try to find an investment which will provide you certain incentives, okay, or exemption, okay, exemption. Like if you engage in regional cooperation, okay, activity, those income that you earn there will be exempted, right? So you have income, but you are not required to declare it as accessible income. So try to do your investment, still earning money, but you are not liable to pay tax. Another example here. One, use an accounting method which may give the best result if the same method for both accounting and tax. Okay, so you have two accounting methods. One is cash basis, one is accrual basis. If you are allowed to choose between two, you choose which method that really reflects your operation. Got it, huh? So if tax authority said you can choose between cash basis or accrual basis, you need to choose which one is really reflective of your operation. If you're really earning income when you only receive money, then you use cash basis. Clear? Am I clear? Don't force yourself to adopt accrual if it is not your regular operation. That's why in small businesses, it's advisable to adopt cash basis, right? Why? Because in small businesses, they will not really give that leniency on credit. So cash, they will receive money by the service or give the product. Okay, so that is more reflective of their own or the true operation. Another one, and this one will be everyone's favorite. I will put our effort in finding out how to minimize income, find ways on minimizing or eliminating certain income wherein we can maximize expenses or allowable deduction. So you can see the lots of things I mentioned here. Right? When you select it. All right. Says here, ensure the ability of the companies to deduct carry forward losses where ownership changes. Remember that 50% changes in ownership. If that changes for more than 50%, what's the next step to check, or what's the next criterion? If there will be more than 50% change in ownership, what will be the next criterion that you need to check? Continuity of business, right? Okay. You have to check whether they still operate in the same business. Then you will be able to what? Claim carry forward loss. Clear? Okay, so two criteria. Huh? Please remember it because when we go to another topic, I think, yeah, that's another one. Anyway, it will be asked again, okay? And this one, realize and realize losses. Sometimes as an accountant, we forgot to realize and realize those losses. With so many things, papers and uh, transaction in zero. What else? Uh, they approved leave leaving prior to year end, regardless of whether leave should take it. Why? Because the annual or in this case approved leave can only be claimed as expense when paid. Got it? Huh? So before year end, pay the accrued leave. Clear? Because you cannot claim the accrued leave as allowable deduction if it is not paid. Remember that? I think we discussed it in allowable deduction. Okay? Last one. Borrow for general business purpose rather than specifically for non-business, so non-deductible purposes. Take note, I'm not telling you to evade tax. When we say let's borrow money for general use, then we use the money for personal use. Okay? So, not like that. It's only saying it's better for you to borrow money for general business expense because if you borrow money for a specific item, there might be possibility that you cannot claim the interest expense. Okay, clear? So when trying to advise your client, you can advise client better to just ask for general business expense loan rather than specific. There might be chances that that particular interest expense on that loan may not be deductible. Okay, clear? So certain strategy. Okay, reduce rate of the tax or defer it. Okay, let's choose one here. Ensure negatively geared investment properties are held by members with the higher income. Okay? Why you want that negative geared investment? It means that with the higher income, if it is negatively geared, that will reduce the higher income instead of you with lower income. Okay? Give it to that individual with higher income, they will reduce their income tax by reducing the assessable income. Ensure that interest-bearing deposits are held by low income earners. Didn't get that point. Anyway. All right. So there are other items here: diverting income, transfer of income, producing assets, high rate taxpayer selling assets to low rate taxpayer. Investment may be given or sold to low rate taxpayers. It's only shifting your money. Same thing with trust, okay? So if you are earning 2 million kina instead of you being taxed at 42%, shift that earning capability to a trust. Remember, trust will have 28% tax. That 28% tax deducted to trust can be used as tax credit. Clear? For the beneficiaries. So if you're rich, create a trust so that your kids will have money. Legal means. What else? Deductible payments by high rate taxpayer to a low rate taxpayer where it is important to ensure that outgoing is deductible. Now, to whom you can actually transfer that possible property or income, here. How many members? If you're rich, you have several companies, give that one company to another, to your one of your child, one of your children. Give. Okay. Run it, do it. Okay. Family partnerships, family companies, discretionary units, unit trust, tax haven vehicles. Okay. I mentioned a while ago that tax planning is related to international tax. And you will see why these two are related. Okay? So we are just laying down the foundation for tax planning. And on the latter part of the presentation, we'll talk about anti-avoidance scheme. Okay, well, matters need to be considered when choosing among entities. Rate of tax. You cannot transfer an income to a person with higher income rate or individual with higher income rate. So you transfer that to an individual with low income rate. Got it? Huh? So the tax rate will be lower on that. Limited liability, formation cost. Of course, if you're thinking about making a company, you also have to think about formation cost. You need to spend money in establishing a company. Continuing administrative costs, of course. If you created an entity, will you be needing to maintain it again and again and again, like creation of company or trust? Yes, so you have to consider that. Ability to distribute losses. Remember now, you can in taxation of companies, if the entities are related, 95% related, you can transfer the loss to an income generating company. Did you recall that in one of our discussions? That loss company and income company. Remember that. So if they have 95% ownership, one company owns 95%, this company can transfer the loss to the company which is earning income. Okay? Stamp duty consequences, level of financing, and use of multiple entity structures. So these are things that you can consider. So am I clear on tax planning portion? Okay, so we are gradually going to the transfer pricing discussion and later on the avoidance scheme, and then next topic will be international tax. These are really related topics. Okay, so currently are you studying advanced cost accounting or cost accounting before? Cost accounting, you remember? Oh, you forgot because of the process costing. Are you doing process costing? Huh? That process costing is really headache, okay? That curriculum, I'm not the main author, but I'm part of that, like who created that module. Sorry, that unit. Which means I'm actually the one suggested that process. Because I'm big. Weighted average, okay, percent first out. Remember that that process cost sheet accounted for, accounted for, headache, right? Okay. The reason why I'm mentioning about cost accounting or advanced cost accounting is because, uh, which means I'm the one introducing the topic. You will talk about the effect of transfer pricing with regards to costing, okay, of a unit. Now, how it works is this. Normally, if a multinational or or a conglomerate operates, they have several companies. Okay, they have several companies. So what they will do is, instead of one company buying to different company, they will buy it within the group. They will buy it within the group. And because these are related party transactions, sorry, related parties, they may end to one. For example, if you have your brother wants to buy your phone, actually you're selling your phone at 1,000 kina. How much you will sell? Because you're my brother, I'll sell it to you for 2,000 kina. I know you rich, so help me 2,000 kina. Even if you do that, that is what we call differentiated pricing. Because you're willing to sell it at 1,000 kina, but because you know your brother will help you, you are selling it at 2,000 kina. Am I clear? Is it true? No, it's not only 2,000 kina. I know my brother. He's a CEO, so I will sell it at 5,000 kina. But still, because you know that information, you sell it like that. Is it possible for these related companies to help each other? Yes or no? Yes or yes? Not another choice. Okay, let's make it in this way. Uh, let's think of related companies here. Okay, the hotel chains. Coral Seas and what's the related hotel for Coral Seas? Sorry, Ella Beach, is it? And then Airways. Are they related? Under one group? Which hotels are related? Tell me. Okay, Coral Seas, under Coral Seas. That Airways. Gateway. Okay. So these are related hotels, right? Is it possible for them that, for example, uh, yes, I know. Later we'll talk about it. So is it possible for them, if they have the merchandise needed by another entity, to sell that materials to them at differentiated price? Like for example, Ella Beach and Gateway, related hotels. Okay? They want to help, Gateway wants to help Ella Beach. They have these materials, let us say maybe linens or something, okay, that they haven't used. So it's just in their warehouse, but it's not used. They bought it, let us say, for 10 million kina, all of those. And then they're willing to help their related hotels. Okay, so instead of selling it at 10 million, of course they want to profit a bit, they will sell it at 11 million. Possible? Yes? Yes, it's possible. Okay? Take note, I'm not saying it's wrong. What I'm saying is it's already given. Related parties will help each other. unless you don't like your brother or sister. I don't think that, especially in Pacific region, you will not help your brother or sister. It's impossible. Okay, you start from Korea, Japan, and go down Philippines, okay, Indonesia, Papua New Guinea, okay, all those islands and Pacific islands. We have the same. We will help our brother and sister. Am I correct? So it's already given. We don't really ask, hey, why are you selling it to your related company? No, it's already given. There, the only problem is if that is used to avoid paying higher tax or the correct tax. Am I clear? If that process is used to reduce tax, clear? That is where transfer pricing will come. Am I clear on what I'm trying to establish? Let's talk about transfer pricing. So, based on the definition provided in Corporate Finance Institute, transfer pricing refers to the prices of goods and services that are exchanged between companies under common control, as I mentioned. For example, if a subsidiary sells goods or rendered services to its holding company or a sister company, the price charged is referred to as transfer price. So, am I clear on this? How about, I'm not really sure now, but is CPL or City Pharmacy still related party to hardware house? Yes. No? They sell it to Taylor Pacific. Uh, what I knew is Stop and Shop is already sold. Taylor Pacific. Hardware house? Not yet. Not yet. So still CPL and hardware house is still related. Right? Just imagine that. If hardware house, if some materials needed by CPL or City Pharmacy, whatever price they charge, we call it transfer price. It's not wrong. It will only be wrong if they use that to what? To avoid paying the correct tax. For example, coming back to that example I've given, we already knew that it's 10 million. So what one company did, instead of charging 11 million, which they want 10% profit, they charge it at 15 million. Got it, huh? And that 15 million becomes an expense on part of the other hotel. It reduces the tax of that hotel. You got it, huh? So this transfer price is only like becoming bad if it is used as a tool to evade paying tax. Clear? Nothing wrong with that. If it is done in the right process, okay. But if it is used as a tool to minimize tax, then IRC will step in. Right. Now, maybe you've heard this base erosion and profit shifting. If not, that's the term BEPS. That's the favorite term around the world. You can see my reference there. It's coming from Organization of Economic Cooperation and Development. Okay. So BEPS refers to tax planning strategies used by multinational enterprises that exploit gaps and mismatches in tax rules to avoid paying tax. The purpose of that is, especially with companies in different countries, they'll try to find a country which charges much lower tax than their own country. I think last time I gave you an example. Singapore is charging 22% corporate tax. Wait. How can we beat that? We are charging 30% here, right? They're 20. Yeah. In Southeast Asia, that's the lowest. I remember Indonesia is around 24. Okay, Thailand is around 23, I think. Okay. Actually, in Southeast Asia, Philippines is the highest. We're charging 25. Huh? So now, as an investor, let's be objective. And there's a way for you to shift the profit where you will place your money. And just thinking as a finance professional, let's set aside first the tax regulations for discussion purposes. In which country you will place your investment or ship your profit? In a country which charges lower tax. Okay. If you can ship, you can ship that money to or profit to Singapore. Because anyway, you will save 8% of the income, right? Just imagine if you're about to pay 30 million kina here in PNG, but you had the chance to shift it to Singapore. Instead of you paying 30 million kina, you will only pay 32 million kina. Okay? But that's bad, huh? Okay, so we'll talk about it. Okay, in section 73 of the new ITA, okay, 2025, so replaces outdated provisions with internationally recognized standards, as I mentioned to you, OECD aligned. Okay? Prevents profit shifting out of PNG through artificial pricing between related parties and ensures taxes paid where the real economic activity and value creation occur. What does it mean? Previously, what they're doing is they will say, this is not, we are only a branch, so we are reporting our profit to headquarters or head office. Got it? So they will say, you cannot tax us. You can tax our remittance around 15%, but our profit is shifted to the head office. That is before what they're doing, okay? But now, under OECD rule, you cannot do it like that. You must know where the real activity or economic activity happens. If it happens in PNG, it should be taxed in PNG. Clear? All right. So where the economic transaction happens. Provides a clear legal basis for the Commissioner General to adjust transactions that do not reflect market conditions. So we already discussed about this. So take note, it also includes supply or acquisition of goods, services, money, including loans, intangibles or the IPs or intellectual properties, and any assets. Must be between associates or related parties. Must be a cross-border transaction. Okay. So in order for this transfer pricing arrangement or to define or classify the transfer pricing arrangement, which is subject to Commissioner General's testing of the pricing, this thing should be complied with. Now you will ask, how about within PNG? Within PNG, it's easy to track because anyway it's within us, so we can always check anytime. But as soon as the money is transferred out of PNG, really hard to take back again. Clear? So before the money leaves, tax. Am I clear on what I'm trying to say? Before the money leaves, you take the tax first. So what does it mean by cross-border? So resident and non-resident, transaction between PNG resident and an entity outside PNG. So simple, straightforward. Two residents. If the transaction relates to a business carried on through a permanent establishment. Hopefully you're clear with this term. Did I mention this in previous discussion? Other company, permanent establishment. The 90 days rule. Okay. Even if it is outside PNG by one or both parties. So what does it mean? It may have stayed there for maybe 120 days and left PNG. So which means they already conducted the business here. We can classify that as under the permanent establishment. Two non-residents. If the transaction relates to business carried on through a permanent establishment inside PNG. So this one, it says, yes, they don't have permanent establishment, but they still conducted the transaction in Papua New Guinea. Okay, so like you're attending a law class, tax, tax legislation seminar. So what is arm's length transaction? Uh, Accountants, you already have fair value concept, right? You studied fair value. What is fair value? It's there. It's in my note, so I wrote it somewhere. What is fair value? Oh, principal amount, okay? So just way to define it. As an accountant, you must remember that fair value. Huh? Okay, so it's a must for you to remember. Fair value is a price where a willing party, okay, will be able to sell or willing to sell, okay, the item, and the party is willing to buy the same item at the same at that price. It's like a meeting of the price. Take note that it says willing, and another one is able. Okay, there should not be forcing. Okay, also I'm able. You must be willing to sell it. Not like that. Okay, it means that you're forcing that it's not really willing. It's unwillingly. Okay, forcing the individual. Okay. So, and when you say fair value or arm's length transaction, uh, it should not be too low or not too high. Too low in the sense that you will say, are you selling this or just giving it to me? Okay. Not too high in the sense that, are you trying to sell it or maybe you just want to tell that you don't want to sell it? Got it? Huh? It's arm's length transaction. So it's same with fair value. It's the same concept. Okay, same concept. All right. So it says here condition that independent person dealing with wholly independently with one another with would reasonably be expected to operate under comparable circumstances. How to determine that one is first real world commercial and financial dealings. If this laptop in the market can be sold for let's say I don't know thousand kina, let's say thousand. So in the real world, it's around 1,000 kina. Maybe 10% difference is fine. Maybe 900 or 1,100, that's fine. Normally, within 10% range, that's acceptable. But if I will sell this at 1,500, that is not under the real world dealing. Got it? Huh? Because we know in the market, I can always buy it at around 1,000 kina. Clear? And I'm not sure if you discussed in accounting, we call it commercial substance. It's the same concept. What commercial substance is this? Same. If this is again 1,000 kina, if I'm giving it to you for 200 kina, do you think that is having commercial substance? Commercial substance means I want at least to profit from it, right? But I'm selling it to you at 200 kina. It doesn't have that commercial substance. So same here, huh? Text. The economic reality of the relationship, not just the legal contract. What happens is that they will put it in paper, but in reality, they are paying different price. Okay, so that's how it works. So there's another example that I want to mention. Oh, there's a good example. Play. All right, compliance obligation. The burden is on the person entering the arrangement to determine their income and expenditure consistent with arm's length transaction. Taxpayer must refer to the specific regulations issued under the Act for acceptable pricing methods. Okay, cost unit price, cost plus discount price. This concept I will not discuss. Okay? I'll leave it to the lecturer of advanced taxation or advanced accounting. All tax components, income gains, losses, and income tax credit must align with these conditions. So what will be the power of Commissioner General? Okay. If the taxpayer fails to reflect arm's length transaction, so the Commissioner General will, of course, or may adjust income, expense, or losses of the taxpayer. So which means the Commissioner General will check your transaction, compare it with real world and the reality, and even the economic substance. Okay, and then they will adjust. Next, okay, the Commissioner General can also adjust tax position of any other person affected by the arrangement to ensure consistency with across the board. That doesn't mean any other person affected by the arrangement. It's not only on one party. Remember, these are related party transactions. So, most likely two parties will be affected. So it's not only one individual, the other individual also will be checked. Okay. Another one, with regards to the authority of the Commissioner General. The Commissioner General has the authority to ignore the form of a contract if the legal form does not match the economic substance. Independent parties would not have entered into such arrangement under comparable circumstances. I want to emphasize this. If given the chance, for example, you have so many options to enter into, still you engage with the related party, okay, then Commissioner General will ask question. Okay. So you had the chance to contact one individual with the good pricing and this. Still you opted to transact with your associate or related party, wherein they are charging more. So the Commissioner General will ask why. Why is it? What will be the answer? What do you think? What do you think will be the answer? No answer there, right? Again, coming back to what I've said about related party, we cannot question one entity helping another entity within the group. Because anyway, they are the same under the economic substance, they are the same. We only question if both of them is trying to play with the rules. Then Commissioner General will ask, like this. Will that really happen? In reality, will that really happen where uh, instead of going to a better price, you're going to pricing given by your associate, although it's they are charging higher price? Answer, most likely will happen. Okay, again, helping each other. Huh? But Commissioner General will be one. We say, sorry, we need to adjust that because we cannot just see the point why you're still transacting there where they are charging twice the price. Wherein you can always ask different suppliers with the same quality but charging less. And another one. Independent parties would have structured the deal differently, which means if different set of individuals or companies will do the same transaction, they will say, I may not be doing the transaction. I may do it differently. Okay? All right. The next one is, I think we already discussed, but I want to emphasize permanent establishment. Okay, for transfer pricing purposes, Section 73.5, subsection 5 introduces the critical frictional separation. So critical separation. Remember, I mentioned about branch. And if the company is branch or just a sales office, taking out a sales office, what they normally do is they're acting as an agent in, let us say, here in Papua New Guinea. So the main function is to sell. Main function is to sell. They don't have that well-established structure to be classified as a separate entity. You got it? Because branch is just an extension of the headquarter. Am I clear about what I'm trying to say? It's like this. Okay? Headquarter of BSP is in Waigani, okay, the corporate business headquarters. They have branch in Boroko, Gordon's. Okay. These are what? Extension of the main office, correct? Is correct? So they're only extending the services provided by the head office. Am I clear on this? Yes? It's the same thing. If the headquarter is in, let us say, in US, they establish what they call, instead of separate company, branch. Branch is just an extension of the head office. They don't have that legal entity. You got it, huh? Because they are only a branch. Am I clear? So what they will say is, we're only a branch, we operate under the headquarters, so our profits will be reported to the headquarters. Clear? That was before. Now, even the branch will be treated as a separate entity. Clear? Am I clear? Because if they treat that as a branch, what they will do is, we are just a branch, our profit should not be reported here, we will report it to headquarters. So if they report it to the headquarters, what will happen? It will be taxed on the headquarters. And here, they will only pay the 15% withholding tax. Clear? That's good tax avoidance. Now it's not allowed. Because here it says, we will establish what we call separation, distinct legal entity, permanent establishment will be treated separately with headquarters person. No more branch these things. Huh? Any dealing between PE or permanent establishment and its headquarters is automatically treated as non-arm's length transaction. So automatically that will be requiring verification by Commissioner General. Something. Do you want to go there or watch the one by one, or are you leaving it? All right. So reciprocity clause. Commissioner General's discretion may choose not to treat a permanent establishment as a separate person. Okay. If this is typically occurs if the foreign country where the headquarters is located does not apply the same separate person rule. So if they are not doing it on their country, we will not also do it here. Okay? So it's better to check the tax legislation on a separate jurisdiction. Okay? Okay, another one. Okay, this prevents mismatches where PNG treats internal transfer as sale, but in other country that will not be treated as sale. So leading to potential double taxation. That's all the thing. It's what they call reciprocity clause, and that is a general rule on international taxation. What does it mean? If they are treating individual here as resident on for example 183 days stay resident taxpayer, they should be consistent in another country. They're also using 183 days as a criterion for resident taxpayer, which is that 183 days is universal. Most of the jurisdictions using that, okay? Which means not only Papua New Guinea, it is used in Australia, New Zealand, okay? It's a universal rule, okay? So that is what we call reciprocity clause. If you are doing it to our companies there, we will also do it here. If you're not doing it in our company there, we will not do it. Okay? Okay, let's talk about documentation. Okay, the one that you're trying to avoid. Paperwork. So documentation and evidence. Documentation, of course, is essential. What to keep? comparability analysis. Why do you need that comparability analysis? When you're trying to engage in transaction between related parties, it's best for you to compare prices with other entities. Why? Because when IRC comes and check you, you can prove. IRC, you see this pricing. We made comparative analysis with other individuals, and we've seen our associate provide the best price. Clear? So IRC will say, okay, you've done well. Okay, you did comparative analysis. And then another one is, which method do you use in transfer pricing? Did you use cost plus model? What is the cost plus method or model? 10 million enough plus 10%. So that is your pricing. Okay? Or you can say 10 million enough plus any selling cost plus 10%. Got it? Huh? So you have to explain what is the pricing model that you use. That pricing model I will not discuss here. Okay? It will be discussed in another unit. I'm just giving you some idea. Intercompany arrangement, if you have intercompany arrangement, if you have financial data and comparable independent companies. If you cannot prove it, it's arm's length transaction, IRC will assume it isn't. Okay? Better prepare. In short, what I would say is, you try your best to prove that your associate provides better pricing. Okay? Or you have the best pricing amongst competitors. That's why your associate selected you. Clear? And any arrangement between you about transfer of resources, there must be like certain memorandum of understanding or memorandum of understanding or memorandum of agreement. Okay? So you put it in the simple, right? And I always say, if you are telling the truth, just put it in paper. You don't need to fear IRC. Right? Yeah, because you have done your work. Try to find suppliers. You put it in writing. You have that arrangement. You explain how the pricing works. You're telling the truth. So what more will you be afraid of IRC? You have all the documents that they will need. Okay, so let's explain this three-tiered documentation. I'll go through the master file and local files. Okay. So in documentation, in section 74, it says on master file, it contains standardized group information relevant to all members of multinational group. Okay. It's like an overview. Local file refers specifically to materials and control transaction of the person in PNG. This file provides the specific details that IRC needs to verify that local pricing is at arm's length transactions. CBC or country by country. Under this section, specified person must furnish CBC report for each fiscal year containing data on how groups' income and taxes are distributed globally. Oh my God, this is really headache. That's a documentation. Anyway, data on how groups' income and taxes are distributed globally. Indicators of where actual economic activity occurs. Okay, so you have to explain. There's a number of data. This allows Commissioner General to perform high-level transfer pricing risk assessment. It seems like IRC don't want you to engage in so many documents. All right. Compliance and record keeping. As an accountant in the future, you must know this. Okay, section 74B explicitly requires any person entering the transfer pricing arrangement to keep a specific documentation. The exact content, requirements, and specification will be prescribed by regulation or as required by Commissioner General. Of course, failure to maintain this documentation will shift the burden of proof heavily on the taxpayer during IRC investigation. In short, keep your files safely and you'll be fine. Now, another section here is what we call tax treaties. In tax treaties, Papua New Guinea entered into, I forgot how many, but around 10 countries. We have tax treaties with 10 countries. They are mostly part of the Commonwealth Association. Australia, New Zealand, UK, one exception, this is Indonesia, Fiji, forget the other ones. South Korea, anyway, 10 countries we entered into tax treaties. That is important because sometimes their citizen works here and our citizens, their citizens may have visited Papua New Guinea or Papua New Guinea visited their countries. And along that line, you may have earned something from that country. By chance, you went to Australia and then you earned 10,000 here. I don't know how. Anyway, you earned. In that way, there's a particular way there, particular tax leniency. So in tax leniency, for example, you earned around 10,000 kina in Australia. If you convert that in Australian dollars, how much? Around 3,000 something, 3,000 kina. That's 3,000 Australian dollars. What I can remember is you are allowed to earn up to 8,000 Australian dollars in Australia within 90 days. Within 90 days, if you stay there, that will not be taxed. Huh? Wait. So I visit my relatives, I earned 10,000 kina, have money. Life is good, okay? Don't worry. When you land here in Papua New Guinea, IRC will ask you that, hey, you need to pay tax for the 10,000 kina, okay? Declare it in your tax return. That also works with Australians. If they earn income here around that 90 days, 8,000 Australian dollars, IRC will not tax them. But once they land in Australia, they need to pay tax them. That's how tax treaties works. Huh? Another one is there are conventions or agreement between other countries like regional cooperation, which allows certain tax leniency. So those are tax treaties. Huh? All right. Well, what do we have here? So out of that discussion, this is the most important. I wanted to take note of this. Section 76 targets foreign entities where a PNG resident holds 50% or greater interest. An entity is low tax. Take note of this, a low tax. If its foreign income tax paid divided by financial accounting profit is below 15%. Under OECD, the rule is the lowest tax is 15%. To be a member of OECD, you must have your corporate tax rate at lowest 15%. I forgot which country in Europe. They just recently joined the OECD. Okay? Because their tax rate is 10%. Corporate tax rate, 10%. So if I have capability of shifting my profits, I'll put my money there. Am I correct? Because they will tax how much? 10%. But there is, I forgot. I think that's Georgia, okay? Country in Europe, Georgia. So they just recently joined OECD. They adjusted 15%. They are actually unwilling to do that. Because anyway, just getting 10% from the company is fine with them. Okay? So I think they've been able to survive. Their economy is stable just by charging 10% for companies. I cannot imagine how efficient their money handling there. Or you're only collecting 10%. It's only GST, okay? Right? So now I'm sure it's Georgia, 15%. Okay. What else? So low entity, 15%, and below 15%, that country will be classified as low entity, okay? Or the company will be classified as low entity. The foreign country does not tax foreign income. It says here, or only taxes when remitted. The jurisdiction has secrecy laws that facilitate the concealment of beneficial ownership. Oh, okay. I'll tell you, Cayman Islands in Caribbean is one of those countries that conceal the identity of the investor, so you will never know who really owns the money. You try to ask them, they will say, "What are you talking about?" So if someone wants to hide the money, they put their money there because no one will be able to see who really owns that except for the owner. Oh. What other countries? Switzerland. Oh. You got lots of money, put it in Switzerland. No one will know. Okay. Their bank secrecy law there is so strict. We have bank secrecy law in Papua New Guinea, but there is really strict. Even government cannot, other government entities cannot push Switzerland to open up their information to others. Really strict. Okay. That's another one. Man of Isle, just between UK and Ireland. There's an island there, Man of Isle. I'm not telling you so that you know where to put the money. Okay? So I'm just telling you that those are examples. Right? Someone is thinking, okay, I'll tell my uncle later. Alright, what else? So automatically Switzerland will be, or sorry, company which operates in Switzerland will be classified as low entity. Another one includes companies, partnership trust, incorporated, managed, or settled in that foreign entity. This one. Why do we need that? Because you need to calculate this. If the entity is classified as low entity, you're not supposed to follow that tax that they paid as tax credit. You need to calculate this. Sorry, so determining the 50% before the, sorry, after this particular calculation of tax. So in determining low tax entity, they must include attributed income in their PNG assessable income, even if no money was sent to PNG applicant. So financial statement says you have 10 million kina there, but you haven't received 10 million kina. And your company there is treated as low entity, low tax entity. So 10 million kina it must be part of the assessable income. Okay, clear? So if you're operating a company on as classified as low tax entity, what you will do with that low tax entity? You will require them to what? Send the money once they declare income. Why? Because even if they don't send the money, you will be taxed here. Am I clear on what I'm trying to say? If they earn 10 million in a debt, but they haven't remitted the money to you here in Papua New Guinea, IRC will still tax that 10 million in. Oh. So the best advice that you can do from that LTE is ask them to remit the money after they declare income. Or else, IRC will tax you. Right? At 10 million PINA if your company times 30%, 3 million. Clear? So what's the formula? A, it says here, or the attributed income equals A multiplied by B. A is the resident's percentage interest on ownership interest, and then the total property income. Not the dividend, take note, not the dividend, but the income. What's the difference? Remember, dividend is only part of the income. Here, you're taxing the whole income. Okay? Am I clear on the difference, accountants? So the difference is, we are not talking about dividends. We are talking about the income. Dividend is only part of the, a portion of the income. Clear? So they will only look into the income rather than dividend. It will only happen if the company is listed or classified as LTE. If not, then okay, that's still fine. Okay, so just regular taxation. Okay, last slide. And my throat can mess up. Too much singing. All right. Avoiding double taxation. That provides mechanism to ensure the same profit isn't taxed twice. So except dividends, when the MP eventually pays the dividend to PNG resident, that dividend is exempt. Of course. Why? Because they already tax it. Okay, that's got it. Huh? Remember, dividend is share of profit. If they already tax the profit, why you will tax the dividend? That's double taxation. So that dividend will be tax exempt. Dividends are treated as being paid first out of the already tax attributed income. So that will be, again, if you paid and then if unfortunately IRC charge tax here, you can take the tax to be as like a tax credit. Then foreign tax, as seen in the formula, the attributed amount is always net of any foreign tax already paid by them, as you can see in this particular formula. Okay. Alright, so I'll end my discussion there. Okay, we'll continue our discussion on anti-avoiding income splitting. It's another important discussion, which is a bridge towards international taxation. Okay, so this will be connecting discussion. All right.